Good evening, everybody. Welcome back. It's going to be Tuesday night, doing a little bit of a deep dive into the Roth IRA, kind of a continuation of my last few TradFi videos, but I'm going to mix this one with TradFi and crypto a little bit, kind of showing you a cascade of how it would work. So let us get started with my outline. I'm going to go into the definition and history of the Roth IRA. I'm going to go into the rules for the money going in and out of them as well. And then I'm going to finish up with how to invest underneath the umbrella that is known as the Roth IRA, the pros and cons to it. So let's take a look. And we'll go into the history of it a little bit. Actually goes back to 1989. It was after a senator named William Roth from Delaware who first proposed this idea of a tax-free retirement account. That was the early days of Bush Sr.'s administration. And Congress, always known for their swift and efficient action, took them 9 years to actually get a law passed called the Taxpayers Relief Act during the Clinton administration. And that was the first time, 1998, when the Roth IRA was made available to the public under this law. And the definition of a Roth IRA, before I go into its rules, it's an individual retirement account funded by after-tax money, so it's already been taxed, up to a certain limit per year, and where growth and withdrawals are tax-free after age 59 and a half, with some specific rules that go along with that. And I'm going to go into kind of the overview on some of these basic rules that you can at least look for to avoid any landmines by actually setting up a Roth IRA so you can invest into assets underneath it. So the basic rules. All right. So you're in 2024, there is a limit per year for how much money contribution wise that you can make to it. That limit is $7,000 per year. Most of my clients anyway, prefer a monthly payment plan. So I set them up on anything from $100 a month all the way up to the max, which is $583 a month. But it's $7,000 per year. So you could drop all $7,000 on one trade at one price point in time for the year. You can do it twice a year, $3,500 each. You could spread them out $1,000 each 7 times. It's up to you. Full control over it because it is your own individual retirement account. After age 50, there is a catch-up provision for $8,000 a year where you can contribute, which would be $665 a month. I think the thinking on this goes is that, and lawmakers are probably right on this, is that most Americans are not saving for retirement. So by the time they wake up at age 50, 51, 52, they're like, I better get started on this. They allow a little bit of a higher ceiling for you to put in on a yearly basis in order to quote unquote catch up, because you can start taking withdrawals at age 59 and a half. And any year after that, any year that you choose, you have full control over it. It must be earned income that goes into it. Wages, tips, commissions, bonuses, etc. This really only comes into play when you're dealing with maybe an 18, 19, or 20-year-old working part-time going to college. And let's say they only make $6,000 during the year because they're only working part-time because they're in school, and they put $7,000 into it. Well, they can't do that because if they only made $6,000 for the year and they put $7,000 into the Roth IRA for the year, that means someone slipped them an extra $1,000. That's not what can go into a Roth IRA from the money going in standpoint. It has to be earned income. In contrast, if they earned $8,000 that year and they put in $7,000, then that's okay. So just keeping that in mind on what kind of money can go into this. There are income limits. This is not designed for wealthy people to stock money into and gazillionaires to put money into so they could have tax-free growth later on. There are more complications than this, but I'm going to keep it simple. For single filers, your adjusted gross income has to be $146,000 or less. And if you're married, you can make up to $230,000 or less without it affecting that $7,000 a year limit in contribution. Now, there's something a little more complicated called modified adjusted gross income. Tax preparers and CPAs deal with that. You can make more than this as a single and a married couple to the tune of about 10 grand. But every $1,000 above these income limits, it affects your ability to put into the Roth IRA. So it drops it down to, by the time you're making $241,000 as a married couple, you are not allowed to put anything in. That's far more complicated than I want to get into in this video. If you're at that threshold or at that limit, each state is different. See the CPA in your state who can kind of walk you through that. And to continue the rules of Roth IRA, so the distributions and the withdrawals may begin after age 59 and a half if the account is open for at least 5 consecutive years. What you're not allowed to do is throw 7,000 a year or 8,000 a year in at age 57, 58, 59, and then start taking withdrawals at age 60. You can do that, but there's penalties accordingly from it. So the two main rules of withdrawals are 59 and a half at least age, and then the account has to have been open for at least 5 consecutive years up until that point. So 54 and a half is the latest you should probably open a Roth IRA if you want everything to work out at least in a timely manner. Otherwise, there's a 10% penalty on withdrawals that have growth to them. I'm going to explain that in a second. So you want to pay attention any type of investment with what your cost basis is. And that's the money that you put into the investment, because that can be withdrawn at any time in a Roth IRA. Not a traditional IRA, but definitely a Roth IRA, because you already pay taxes on that money. If you put 1,000 in and it grows to 1,500, you could still take that 1,000 out without any penalties, but there will be penalties on that growth of the 500 on top of that. So you want to be careful with this. There are some other things I'm going to go through with pulling money out of a Roth. But again, this is not a put and take account. This is not your savings account at your bank where you put money in and then take money out, put money in, take money out. Whatever's going into this, just think long term that you're not going to touch it for a very long time, and keep that in mind. Don't look at it. Don't don't be tempted, because you can pull it out if it's a cost basis. This is a long-term 20, 25, 30-year investment time horizon. Just keep that in mind. Now, there are exceptions to the 10% penalty. And one of those is if you are a first-time home buyer, you can withdraw $10,000 without penalty to go through down payment, closing costs on your first time buying a home. That is one exception to that 10% penalty. Second one is if you have a disability status confirmed by a physician. That could be physical or it could be mental, something that would definitely prevent you from earning income. The lawmakers were at least wise enough to put into this status that, if you're disabled to the point where you can't work, you're probably going to need money prior to age 59 if you get disabled before age 59. So at least there was some common sense put into that for disability status. And there are qualified withdrawals that you could make to pay for education. There's no penalty on doing that, but if the money does come out that isn't your cost basis and you start digging into the growth, you have to pay taxes on the growth because it's before age 59 and a half. It's not designed for an educational savings account. There are educational savings accounts themselves, but a Roth IRA can be one of those options, at least a little bit different from putting your money in an ESA under that circumstance. So these are just the basics. And now I'm going to shift gears. I'm going to go to my white note and kind of go into what this would look like and how to invest. I'm going to give you 3 separate examples and then how to do it, and then some things to think about later on. So let's go to the audio tape, shall we? All right. So if you've remembered from my last video, my retarded umbrella, the purpose of the retarded umbrella is to show you that is what a Roth IRA is. So I'm going to write Roth IRA, and those red rain drops coming down, not the Peter Gabriel song. That is the IRS. What the Roth IRA does is protect you from the IRS in that case. So looking at this is that your money going into this account is going to shield whatever assets you're investing in from any taxes on growth that you would normally accumulate in just your individual brokerage account with Fidelity or TD Ameritrade or anything else. And I'm going to look at one method is I'm going to use mutual funds. I'm using an aggressive growth fund, and I'm going to pick one seemingly at random. Let's go to this, and I'll just do Franklin Templeton because I'm familiar with Franklin Templeton. So and again, this is incidental to my job as an educator. I am not recommending Franklin Templeton mutual funds. I'm very aware of them. Probably the rest of the world is. They've been a very long-standing company. But let's go, at least into this sense where if you go to Franklin Templeton page, you can take a look, and when you hover over investments, they have a bunch of them: mutual funds, exchange traded funds, individual account that you're going to manage, 521 for education. Whatever you're looking for, you can find. Let's go to mutual funds. And I'm going to pull up, you can actually filter by this, and I'm going to do equities. Because why the hell not, right? We're saving for retirement. That's the long term. So when they sort and filter this out on equities, you can sort by the focus of it, the fund name, the share class if you want to. Here, they're going to give you a lot of the different performance over 1, 3, 5, 10 years, and also since inception. So I'm going to sort by inception, not on the low end, but on the top end. So remember, my rule was at least 25 years of a track record under that equity class or that bond class or that equity and income class. In this case, we're doing aggressive growth funds or something that would be equities and not bond and not income. And you can see this one goes back 11 years. It's averaged 13.06% rate of return annually. Now, again, that's only 11 years, so I don't look at that. So then I go back here. All right, this one goes back to 2010. It's averaged 12.17% rate of return. That's, again, only 14 years. Now, this one goes back to 1949. Ain't that something? 12.13. 2015, not long enough. So the one that goes back to 1949, that's a potential one that I would look at. But I'm going to go over to this one, 1982. ClearBridge Value Fund. So here's the 1-year rate of return, 19.26, 3-year rate of return, 6.97, 5-year, 11.42. And then over 10 years, you could probably, at least the past 10 years, you'd expect a 9.04. But since 1982, that's 42 years. That's a decent track record to look at if you're going to look for a long-term investment going forward. Past results don't indicate future returns, but again, I'm looking for a track record of at least 25 years, and the ClearBridge Value Fund fits into that dynamic. So let's go back to my retarded umbrella. And what we're going to do is we're going to max out our Roth IRA with the ClearBridge Mutual Fund. It's a ClearBridge Value Fund. And we're going to do maxing out is $583 a month times at a 11.37% rate of return for 30 years. And another month, we're buying shares of the value fund, the ClearBridge Value Fund. Up, down, up, down, up, down. You saw the past 10-year volatility, but let's just suppose that the market does just as crappy for the next 30 years as it's done for the last 30 years, and you get the 11.37 rate of return over 30 years. You will have accumulated in your Roth IRA with that fund alone, nothing else, $1,807,047. And let's just say you want to take 5% out per year because you're past age 59 and a half and you're ready to start taking withdrawals. That 1.87 million, if you have it in a 6% account, let's say, and you just take 5% out, that principal 1.8707 million will stay there. But what it will produce for you as you're skimming off the top is $90,352 per year. And that works out to $7,529 per month, tax-free. If you remember my last two videos dealing with the difference between a 401k and a Roth IRA, I went into that and the differences between the two from a growth and a tax standpoint. And then I also did one on your taxes in retirement. If you just have a Roth IRA and you just did one value fund for 30 years, averaging 11.37, maxing out your IRA every month, you're gonna build a chunk of change in there, 1.8 million, to be honest with you. And who knows what 7,500 a month will look like 30 years from now, but at least gives you something to plan for and something to aim for. So that's one option Letter A, we'll call it investing into a value fund, a mutual fund, with the IRA shielding you from the IRS at that rate of return. That's what you get. That's what you can skim off. That's what you get paid per month tax-free. So you can actually put that into your asset budget, part of your budget, $7,500 a month coming in. Income. All right, let's take round 2. We'll call this letter B. And instead of a mutual fund, we're going to invest in one stock, Amazon stock, from 1998 to 2002, when the Roth IRA actually started. Now, the contribution limits in the early days of a Roth IRA back in the late 90s, early 2000s was only $2,000 a year. It wasn't the $7,000 a year it is now. That has increased due to, realizing inflationary times, and the money's just been printed into oblivion. You're getting to a point now where $2,000 wouldn't be enough to save for retirement. That's why it keeps bumping up every year. But let's look at, I'm going to actually spell this out because I did the actual data on Amazon stock. And let's say you dropped, instead of on a monthly basis, you dropped $2,000 per year for 5 years, from 98 to 2002. And you got the average stock price, share price of Amazon each year you did that. You didn't get the high point, you didn't get the low, but you just dropped $2,000 every year, once a year, kind of randomly, threw a dart, and the day of the year, threw a dart on the calendar, and that's the day of the year that you actually decided to invest. So in 1998, the average share price wasn't the high, wasn't low, but it was 89 cents for Amazon stock. Went through a little bit of an explosion in the late 90s, ended up being $3.50 a share. That was the average. A little bit higher sometimes, a little bit low, but that was the average. In 2000, it was $2.25. And then Amazon was like the XRP of the 90s and 2000s, because by 2001, it was down to 68 cents and then down to 80, or a little bit up to 81 cents in those years. So when you dropped $2,000 on each of these, I'm going to go to orange just for the share amount. In that first year, you were able to get 2,247 shares. The next year, because it got more expensive, $2,000 didn't go as far, so you only got 571. Third year, you were able to get a little bit more, 888. And as it crashed, you kept throwing that $2,000 in, dollar cost averaging on a yearly basis. And then for that last one, 2,469. So what that gave you was 9,116 shares of Amazon stock at the end of 2002. You didn't put another thing into your IRA. You maxed it out every year for 5 years. And you just let it sit there all the way until yesterday, or the day before yesterday, when Amazon hit its all-time high of $180 and change. We'll just do that. Let's say you decided to cash out at that point, because, even if you're not 59 and a half, you could still cash out of whatever you have invested in. You can make trades all day long in a Roth IRA, and there's no tax implications for it to do. But if you just decided to do that, that would have given you 1.640 million. Now put that into a 5% vehicle. We're just going to skim off the top. That'll give you 82,044 per year. And then if you want to break it down by month, that's 6,837 per month. Again, tax-free. Right. So there's the advantage of the umbrella, which I didn't put in there, which I will now. This is your Roth IRA. You don't invest in an IRA. You just use it as a shield to whatever your assets are that you're putting and investing in underneath it. In this case, Amazon stock during its penny stock prime, when you could get in for that little, not realizing probably at the time the behemoth that Amazon would turn into today. But you only invested what, $2,000 for 5 years? That's $10,000. Whereas the other one, you invested 7,000, the mutual fund, You invested 7,000 a year for 30 years. That's 210 grand. So you invested 210 grand, you get 1.8 million. Or in this case, you just had the foresight to invest 10 grand for, 2 grand for 5 years, and you got 1.6 million. So, you tell me who got the rate of return, at least on that. Both are feasible to do. There's no right or wrong way to do this necessarily. Naturally, you don't want to put it in overly risky investments in your retirement account and depend on, lottery tickets to go in there. But, do you believe in the company? Is it solid? Are the fundamentals and the financial sound? Those are the things you want to be investing in long term, particularly for retirement. Now, what about crypto? Can XRP go into a Roth IRA? Well, let's take a look and see what would happen. Let's say instead of 5 years like Amazon or 30 years like the mutual fund, you just do one lump sum payment to max out your IRA into XRP at what? 52 cents? So you just drop one into the IRA and just leave it there. That's 13,461 XRP. Now, what happens if you hold it on until age 59 and a half, and that's 10 years from now? Now, everybody's frustrated about the price now of XRP, but, at $100, let's say, 10 years from now, let's say it could go there. So at $100, you're looking at what? 1.346 million. At $300, what are we looking at? 4.038 million. Again, securing the gains that you do have. If it's underneath a Roth IRA, whatever growth you have on this is tax-free. And what happens if you decide to just skim off 5% there? Well, if it does go to 300 and you capture that and you're just skimming 5% off, that's paying you $201,923 a year, which is basically $16,826 per month. Tax-free. Have I mentioned that this stuff is tax-free? So while I can't say that, and we did A and B, so this is letter C. And I can't say that one is better than the other, It all goes down to risk, whether you're risk adverse, what your time horizon is, how much money you have to invest. Accordingly, these are all important factors that you have to think about. And it couldn't hurt to do this a little bit of each, a little bit of A, a little bit of B, a little bit of C. Because at the end of the day, you could do it this way. You could have one IRA with one custodian, and you just put the 7 grand in per year to max it out there. Or you could have 2 IRAs, and you decide to put $3,500 in each of them. This is spreading out the risk on a brokerage. This could be TD. This could be Fidelity. You can have more than one Roth IRA, and mainly because if you don't like the way TD is working, you can roll that over into your Fidelity account and transfer those funds, not roll over, but transfer those assets. You could have 7 different IRAs, Roth IRAs, and just put $1,000 in each of them. Maybe you have 7 different brokerage accounts and brokerage companies that you're looking to spread your risk out. Maybe you want to try to see which one gives you the best return based on their advice. So you put $1,000 into 7 of them. And after a year, 2 or 3, you see which one has done the best, and you can roll the other 6 into that 7 if you don't like the way the other 6 have performed, or roll 3 into the other 3. And if it's fitting the investment objective that you're looking at. The beauty of an IRA as an individual retirement account is that you have full control over it. You can manage this as you see fit. The key is that you can't go over that $7,000 limit if you're under age 50. So that's what I mean. You could have 7 different brokerages with 7 different Roth IRAs. As long as you don't go over the $7,000 cap annually, you're in the clear. You can have as many as you want to de-risk whoever you're investing with. Sometimes people find it easier just to put it with one brokerage or maybe with a financial advisor they trust. Again, nothing wrong with that. I'm not here to judge or tell you what you should do. I'm only here to show you what you could